Hi, I am CA Vijay Kedia. Welcome to my channel. So in today's video, we are going to discuss about when is the right time to exit a mutual fund. Because when it comes to investing, you might have heard about multiple strategies, SIP plans, lump sum. But when it comes to exiting the mutual fund, most of the time people do make mistakes. They are not able to decide when it is the right time to exit a mutual fund. Some people get affected by the market volatility. When the market is going up, they think it's not the right time to invest and they even stop their SIPs. But when the market is going down, instead of staying invested, they panic and start redeeming their investments, thinking that market may go down further, and then they lose the opportunity to get the real return on their investment when the market again goes up. The first scenario where you should exit your fund is the time when you are reaching your financial goals. So if you are closer to your financial goals, say you were investing for a particular goal, maybe for buying a car or a house or your kids' education or whatever be your financial goal, and that goal is 2-3 years away, and that is the time you should start planning exiting your mutual fund, because you cannot exit whenever you want to, because if you try to exit at the time when you are very closer to your goal, that time the market might be down and you might not get the kind of returns which you expected. So it's always advisable to plan your exit 2-3 years in advance. For example, you need some money in 2026 or 2027, you should start planning that now. Right now market is on all-time high, so you can plan to exit some of the funds, and then again in few months, again when you see the opportunity, you again plan that exit. So that should be one of the reason to sell your mutual funds when you are reaching closer to your goal, so that, and it's better than exiting at the lump sum. So the way you follow this strategy to do a systematic investment, same way you need to follow the strategy to do a systematic exit also. Second scenario where most of the people ask, what if my mutual fund is not performing, right? Should I exit that fund? Yes. So if your mutual fund is not even beating the benchmark consistently, and I'm saying consistently because if you look at last 1 month, 2 months, 6 months returns, that's not the ideal way to compare. You should compare the performance over the last 1, 2, 3 years, and still if you are seeing that your mutual funds are not able to beat the benchmark or its peers and it's consistently underperforming, then yes, you can consider switching to a different fund. But don't go by the short-term volatility, because in 6 months or 1 year of time frame is very short time to compare two mutual funds. Third scenario which I want to talk about is portfolio rebalancing. So if you are following proper financial planning, you must be aware that we need to follow a asset allocation strategy. Maybe 70% should be in equity, 30% should be in debt, or maybe if you are an aggressive investor, 80% should be equity, 20% should be in debt. And that is all depends on person to person, their risk profile. So whatever the investing strategy you have planned for yourself, or your financial advisor has planned for you, you need to follow that strategy. You need to maintain that asset allocation. And then if the market goes up and you're seeing that, okay, I planned for 70% equity, but now the proportion of equity in my overall portfolio is 75% because the equity component has gone up. In that scenario, you might consider selling some of your mutual funds and then move it towards debt components, maybe debt mutual funds. So that is a valid reason if you want to do a portfolio rebalancing, and that applies other way around also. So for example, if the market is going down, your equity component value has decreased and your debt component has increased, so then you sell some of the debt funds and then move that money to equity fund, so that your allocation is maintained. You need not to do it very frequently, but maybe once every 6 months or once every year you can do that exercise. And the fourth one I wanted to talk about is the tax harvesting. So, and that is also a very important aspect you should consider, because every year you get an exemption of 1.25 lakhs on capital gain of equity fund. So every year you should try to utilize that tax rebate basically to consolidate your overall portfolio. For example, maybe you have invested in too many mutual funds, and in some cases the funds are overlapping, so they have similar kind of investments. So every year you can try exiting some of your overlapping funds or regular funds to direct funds and to funds where you can consolidate. So you have three funds in the same category and you want to keep only one of them, and so the remaining two funds you should not exit at one go, because that time your tax liability might be higher. So slowly you can plan every year to exit some portion of your overlapping portfolio and then invest that into your the other fund where you want to maintain your allocation. And this way you'll be able to utilize 1.25 lakhs of capital gain exemption, and you'll not have to pay tax on that portion. Next year again you can utilize exemption, and then it will help you to consolidate your portfolio, right? So these are the some of the valid reasons I consider for selling my mutual funds. So, and apart from that, I don't think there should be a valid reason to sell a fund if the fund is doing fine and your goal is still a few years away, just because of the market volatility or somebody is asking you to do so. Don't plan or don't redeem your funds based on that kind of scenario. So hope you like this video. Please hit the like button, subscribe if you have not done already, and do share with your friends and colleagues who might find it useful, and I'll see you in the next video. Thank you.